Macroeconomics for Investors. Chapter 11, Monetary Policy. Section 1, Monetary Policy Basics. Monetary policy is the central bank's way of shaping the financial environment in which the economy operates. It does not directly command companies to hire more people or force prices to stop rising. Instead, it influences money, credit, and interest rates, which then affect borrowing, spending, saving, and investment decisions across the economy. That is why economists describe monetary policy as working through financial conditions rather than through direct control. When policy is working well, it helps keep growth more stable, inflation more contained, and financial stress less severe. For investors, the key idea is simple. Central banks guide the conditions that influence outcomes, even though they cannot perfectly determine those outcomes. Most central banks are trying to balance a similar set of broad goals, even if their legal mandates are worded a little differently. One major goal is supporting maximum sustainable employment, meaning as many people working as the economy can support without creating lasting inflation pressure. Another is keeping inflation under control so that purchasing power remains relatively stable and businesses can plan with more confidence. A third is promoting moderate long-term interest rates, which helps avoid a world of persistently punishing borrowing costs. These goals can pull against one another in the short run, which is why policy is often about trade-offs rather than perfection. A rate cut might help jobs, for example, but if demand is already too strong, it can worsen inflation. Investors should think of central banking as a balancing act between price stability, labor market health, and broader financial conditions. Monetary policy is set by central banks, not by the part of government that handles taxes and spending. In the United States, that role belongs to the Federal Reserve. In the Euro area, it belongs to the European Central Bank. And in Japan, the Bank of Japan. This distinction matters because fiscal policy and monetary policy work through different tools and institutions. Governments decide budgets, taxes, and public spending, while central banks influence interest rates, bank reserves, and overall financial conditions. Many central banks are designed to operate with some independence from day-to-day politics, because controlling inflation often requires unpopular short-term decisions. That independence is never absolute, but it helps policymakers focus on longer-term stability instead of election cycles. For investors, knowing which institution is speaking is essential, because a finance minister and a central banker can move markets for very different reasons. In broad terms, central banks usually move policy in one of two directions: tightening or easing. Tightening means making borrowing more expensive or reducing liquidity in the system, usually because inflation is too high or demand is running too hot. Easing means lowering borrowing costs or adding liquidity, usually because growth is weak, unemployment is elevated, or inflation is too low. The labels sound simple, but they describe two very different policy environments for markets and the real economy. Tightening is meant to support it. Neither is good or bad on its own. Each is a response to a particular economic problem. For investors, recognizing which regime is in place is one of the most important starting points for interpreting rates, valuations, and risk appetite. A policy decision reaches the economy through what economists call the transmission mechanism. It often starts with the policy rate, which influences very short-term market rates and bank funding costs almost immediately. From there, the effects spread outward into mortgage rates, business loans, consumer credit, and bond yields. Asset prices and exchange rates can also move as investors reprice future growth, inflation, and policy expectations. Households then react by changing how much they borrow, spend, or save, and businesses react by adjusting hiring and investment plans. This is why monetary policy moves through markets first and the real economy later. Understanding that chain helps investors avoid treating a central bank announcement as the final effect, when in reality it is only the first link. A rate hike does not lower prices directly at the checkout counter. What it does is make financing more expensive, which tends to slow demand over time. If the business faces a higher borrowing cost, it may delay a factory expansion, cancel an equipment purchase, or hire more cautiously. If a household faces a higher mortgage payment or a more expensive auto loan, it may postpone buying a home, car, or other large item. When enough of those decisions change across the economy, total borrowing and spending begin to cool. That weaker demand can reduce pressure on firms to keep raising prices. The important lesson is that monetary policy works indirectly, through financing conditions rather than by directly setting the price of goods and services. Policymakers do not make one decision and walk away. They operate in a continuous cycle. They begin with goals such as price stability and sustainable employment. Then they study incoming data on inflation, jobs, growth, spending, and credit. Based on that evidence, they choose whether to tighten, ease, or simply hold policy steady. They may use the policy rate as the main tool, and sometimes balance sheet actions as a supporting tool. Just as important, they explain what they did and why, because markets respond not only to the action itself, but also to the message around it. After that, they watch how financial conditions and the economy respond and update their judgment. For investors, central banking is best understood as an iterative process of read, decide, communicate, and reassess. Monetary policy is powerful, but it has real limits. One of the biggest is timing. The full effects often take many months, sometimes 6 to 18, to show up in growth and inflation data. That means central banks must act based on forecasts of where the economy is going, not just where it is today. Traditional rate cuts also become less effective when rates are already near zero, because there's only so much room to lower them further. And even well-designed policy can be thrown off by supply shocks, geopolitical events, commodity spikes, or sudden financial stress. A central bank can influence demand, but it cannot fully control every force affecting inflation or growth. For investors, this is a reminder that policy should be judged probabilistically, not as if it were a precise engineering tool. A useful example came in 2023, when the Federal Reserve was still facing inflation above its long-run target. Inflation had cooled from its peak, but around 3.2% year over year. It was still too high relative to a 2% objective, and the labor market remained firm. In that environment, the Fed raised rates by another quarter point, moving the target range to 25 to 50%. The logic was not that a small hike would immediately reduce prices, but that higher borrowing costs would continue restraining demand. That pressure could show up through mortgages, business credit, consumer loans, and broader financial conditions. This is a good example of policy responding to the combination of still hot inflation and still resilient economic activity. For investors, it shows how central banks often tighten, not because the economy is collapsing, but because it is proving strong enough to keep inflation elevated. Several common mistakes can distort how people interpret central bank actions. One is confusing monetary policy with fiscal policy, even though one is mainly about rates and liquidity while the other is about taxes and government spending. Another is assuming central banks can fine-tune the economy with perfect precision, when in reality they work with long lags and uncertain transmission. It is also a mistake to assume that low rates automatically mean easy policy, because if inflation is high or credit is tight, the true stance may still be restrictive. Politics, global shocks, and market structure can also shape outcomes in ways that central banks do not fully control. That is why a single headline rate number rarely tells the whole story. Investors need to interpret policy in context, not in isolation. If inflation is running at 4 or 5% against a 2% target, unemployment is only 3.8%, and GDP growth is still around 2.5%. The most defensible stance is usually tighter policy. Inflation is clearly above target, while the labor market and output data suggest the economy is not in obvious distress. In that setting, easing would risk adding more demand to an economy that is already generating too much price pressure. Holding steady could be defensible if policymakers believed prior tightening had not yet fully arrived, but the high inflation reading still argues for a restrictive bias. Tightening makes the most sense when price stability is the main objective under threat, and the economy appears resilient enough to absorb some cooling. This kind of exercise is exactly how policy judgment works in practice, weighing inflation, employment, and growth together rather than staring at any one number. For investors, learning to frame the data this way is far more useful than memorizing definitions. Section 2. Tightening versus easing. With the basics in place, the central choice in monetary policy becomes easier to frame. Should the central bank cool demand or support it? Tightening is the direction used when inflation risks are too high and the economy needs to slow to a more sustainable pace. Easing is the direction used when growth is too weak and policymakers want to encourage more borrowing, spending, and hiring. The distinction sounds clean, but the decision is rarely obvious because central banks must weigh inflation, employment, growth, and financial conditions at the same time. An economy can have slowing growth, but still stubborn inflation, or weak inflation, but unstable financial markets. That is why monetary policy is not a simple switch between good and bad conditions. For investors, the important habit is to ask which problem policymakers are trying to solve. Central banks usually tighten when the economy starts to look overheated. Inflation running above target is the clearest signal, but they also watch for very rapid credit growth, unusually strong spending, and signs that asset prices may be driven by speculation rather than fundamentals. In those conditions, the concern is that demand is outrunning the economy's productive capacity. Tightening is meant to bring demand back into better balance, not to force the economy into a contraction for its own sake. That distinction matters because the goal is cooling, not destruction. A well-timed tightening cycle tries to reduce inflation pressure before it becomes more damaging and more costly to fix later. For investors, overheating often shows up not just in CPI, but also in credit markets, housing, and stretched valuations. Tightening works by making money and credit less easy to obtain. The most familiar tool is raising the policy interest rate, which lifts borrowing costs across short-term funding markets and gradually influences many other rates. Central banks can also sell government securities, which withdraws reserves from the banking system, and in some systems they can raise reserve requirements, which limits banks' lending capacity. The combined effect is tighter financial conditions. Mortgages become more expensive, business loans cost more, and some consumer credit becomes less attractive. As borrowing slows, spending and investment tend to slow as well, which reduces inflation pressure over time. The key phrase is over time, because tightening is rarely immediate and often works with a long and uneven lag. Easing is the opposite response, and it is usually chosen when the economy is weak rather than overheated. If unemployment is high, inflation is very low or falling, and growth is weak or negative, central banks may decide that the bigger risk is insufficient demand. Lower rates can make borrowing cheaper, encourage spending, and improve the willingness of businesses to invest. Easing is also important when policymakers fear deflation because falling prices can lead households and firms to delay purchases and investment. In that environment, policy aims to support employment and stabilize activity before weakness feeds on itself. The central bank is trying to keep a downturn from becoming deeper and more persistent. For investors, easing often begins in response to deteriorating data, but markets will quickly start pricing its eventual effect on growth and asset values. Easing works through lower rates and more liquidity. A central bank can cut the policy rate, buy bonds or other assets, and in some cases lower reserve requirements to make credit conditions more supportive. Those actions can reduce short-term funding costs and, especially with asset purchases, put downward pressure on some longer-term yields as well. Cheaper financing can help households refinance, encourage home purchases, support business investment, and reduce debt service strain. It can also push investors away from very safe, low-yield assets and toward riskier assets, which can support prices for stocks, corporate bonds, and real estate. But the purpose is not simply to boost markets, it is to make financial conditions easier so that economic activity improves. Investors should remember that easing affects both the real economy and the relative appeal of different asset classes. In theory, the policy choice can sound obvious: tighten when inflation is high and ease when growth is weak. In practice, the choice is hard because the effects arrive late and policymakers must act under uncertainty. Tighten too quickly or too aggressively, and the result can be a sharper slowdown, credit stress, or even financial instability. Ease too much, and the economy can overheat again, asset bubbles can form, or inflation can become harder to control. Credibility adds another layer, because markets react differently when they trust the central bank's commitment and communication. If inflation expectations are well anchored, a smaller move may do more work. If not, even large moves may struggle. For investors, this means policy decisions should be judged not only by direction, but by timing, scale, and credibility. Once a central bank chooses a direction, the decision still has to travel through the financial system before it reaches the broader economy. Policymakers, review data on inflation, jobs, growth, and credit. Then decide whether to change rates, reserves, or market operations. Banks react by adjusting loan pricing, deposit rates, and sometimes lending standards. Borrowers and investors then respond, but not all at once and not in equal measure. Some effects show up quickly in funding costs and market prices, while others take months to affect mortgages, business plans, and household spending. That is why economists often talk about a 6 to 18-month lag before the broader growth and inflation effects become visible. For investors, understanding this timeline helps separate immediate repricing from slower economic transmission. The U.S. tightening cycle that began in 2022 is a clear example of contractionary policy in action. Inflation had surged to about 8.5%, far above the Fed's 2% target, while unemployment was still low around 3.6% target, That combination told policymakers that demand remained strong enough to sustain elevated inflation. In response, the Federal Reserve raised rates from near zero to above 5% in a relatively short period. Over time, inflation did fall to around 3%, which suggested that tighter conditions were helping, but the process was not painless. Mortgage costs rose, housing cooled, and financial strain appeared in parts of the banking system in early 2023. For investors, this example shows both sides of tightening. It can restore inflation credibility, but it can also expose vulnerabilities created during the easy money period before it. The euro area in 2014 and 2015 offers a contrasting example of easing. Inflation was below 0.5%. Growth was very weak, and policymakers worried that the region could slip into a prolonged low inflation trap. The European Central Bank responded by cutting its deposit rate to negative levels, eventually reaching -0.4%, and by purchasing bonds. Those actions were designed to lower borrowing costs, weaken the euro, and support demand through easier financial conditions. A weaker currency could also help exports by making euro area goods more competitive abroad. At the same time, the policy was controversial because very low and negative rates put pressure on bank profitability and raised concerns about excessive risk-taking. For investors, this episode shows that easing can support demand, but it can also create side effects that matter for banks, currencies, and asset prices. There are several trade-offs investors should keep in mind when thinking about tightening and easing. Inflation usually does not fall immediately after tightening begins, so judging policy too early can lead to bad conclusions. On the other side, easing may be too weak to restart borrowing in a severe downturn, especially if banks are cautious and private balance sheets are damaged. It is also important to distinguish direction from strength. Saying policy is tightening tells you where it is moving, not how powerful the move will be. Exchange rates and financial stability can complicate the picture further, because a decision that helps inflation might also create stress elsewhere. Monetary policy is therefore never free, immediate, or guaranteed to work perfectly. Investors are better served by thinking in terms of transmission and trade-offs than by expecting clean, one-step outcomes. Section 3. Interest rate policy. In most modern economies, the main instrument of monetary policy is a short-term policy interest rate. When people hear that a central bank raised or cut rates, this is usually the rate being discussed. It serves as the starting point for a much broader set of borrowing costs and saving returns across the financial system. Banks, money markets, and investors all take cues from that short-term benchmark. The policy rate does not directly set mortgage rates, corporate bond yields, or deposit rates, but it exerts strong influence over them. That is why interest rate policy sits at the center of modern monetary policy. For investors, understanding the policy rate means understanding the first lever central banks usually pull. A change in the policy rate affects many other rates, but not in a mechanical one-for-one way. Banks often adjust lending rates and deposit rates relatively quickly, especially for products that are closely tied to short-term funding conditions. Mortgage rates and auto loans can move too, but they are also influenced by longer-term yields and market expectations. Credit card rates may respond faster in some systems, while corporate borrowing costs depend partly on credit spreads as well as government yields. Bond yields across the curve can shift, though their movement reflects not only today's policy rate, but also the expected path of future rates and inflation. Savings returns can rise or fall too, though banks do not always pass through changes equally to borrowers and depositors. For investors, the point is that transmission is powerful but uneven, with different products reacting at different speeds and by different amounts. Central banks raise or lower rates to shape overall demand. If inflation is too high or the economy looks overheated, higher rates make borrowing more expensive and tend to cool spending and investment. If growth is weak or unemployment is rising, lower rates can encourage households and firms to borrow, spend, and expand. The objective is not rate changes for their own sake, but a change in economic behavior. Higher rates are meant to reduce inflation pressure by slowing demand. Lower rates are meant to support activity by improving financial conditions. The same tool is used in opposite directions depending on the problem policymakers are facing. For investors, it is important to connect the rate move to the economic objective behind it, rather than treating every hike or cut as a standalone event. The nominal rate is the stated interest rate you see quoted, but the real rate is often more informative. Real rates adjust for inflation, and a simple way to think about them is nominal rate minus inflation. If the policy rate is 3%, but inflation is 4%, the real rate is roughly minus 1%. That means borrowing may still feel relatively cheap in inflation-adjusted terms, even though the nominal rate is positive. Real rates therefore give a better sense of whether policy is truly restrictive or supportive. A central bank can look like it has raised rates substantially, yet if inflation has risen even faster, policy may still not be very tight. For investors, this is one of the most important filters for interpreting the true stance of monetary policy. Interest rate policy moves through the economy in a sequence rather than all at once. The central bank first sets or signals a target rate, and its operations help hold very short-term market rates toward that target. Banks and lenders then adjust loan rates, deposit rates, and other funding terms. Households react through decisions about mortgages, autos, credit cards, and saving, while firms react through financing and investment choices. Only after those behavioral changes accumulate do we see clear effects on growth, hiring, and inflation. This is why rate policy often feels immediate in markets but delayed in the broader economy. Investors who understand this chain are less likely to overreact to the first headline and more likely to watch the follow-through. Communication is not separate from policy. It is part of policy. Markets care not only about the current rate, but also about where they think rates are headed over the coming months and years. If a central bank signals that rates may stay high for longer-term yields, and risk assets can move even without a fresh hike. If it signals a likely pivot to cuts, conditions can ease before any actual cut occurs. That is why central banks often move gradually and spend so much time explaining their reasoning. Clear communication can anchor expectations and reduce volatility, while surprises can create sharp market swings. For investors, following the statement, press conference, and guidance can be just as important as following the rate decision itself. A practical example makes the transmission process easier to see. If the Fed raises its target rate from 5.00% to 5.25%, a bank may lift its prime rate from 8.00% to 8.25% soon afterward. Mortgage rates might also move higher, say from 6 times to 7.1%, increasing monthly payments for new borrowers. For some households, that change is enough to delay a home purchase. For some businesses, it is enough to postpone an equipment investment. At the same time, savers may receive slightly better returns on deposits or money market balances. So the same small policy move can restrain some forms of spending while modestly benefiting holders of cash-like assets. For investors, that ripple effect is exactly why small changes in the policy rate can still matter a great deal. Interest rate policy is powerful, but it has several important limits. The policy rate is not the same thing as the rates households and firms actually face, and those borrowing rates may move by very different amounts. The effects also take time because banks, borrowers, and spending decisions do not all adjust immediately. During financial stress, even rate cuts may fail to revive borrowing if lenders are cautious or borrowers are already overloaded with debt. There is also the lower bound problem. Conventional policy becomes less effective when rates are already near zero, and longer-term market rates can diverge from the policy rate if inflation expectations risk premia, or global conditions are moving differently. For investors, this means rate policy should be viewed as influential, but not all-controlling. What matters most for investors is not just whether rates moved, but why they moved and what the broader stance really is. A hike made to contain overheating inflation means something different from a hike driven by a desire to rebuild policy room or defend credibility. Looking at nominal rates alone can also mislead, so comparing rates with inflation to estimate the real stance is critical. Timing matters too, because policy works with lags and markets often move long before economic data fully reflect the change. Higher rates tend to cool demand and lower rates tend to support it. But the path from decision to outcome is rarely smooth. Investors should therefore ask 3 questions. What problem is the central bank addressing? How tight or loose is policy in real terms? And how long might transmission take? Those questions usually matter more than the headline move itself. Section 4. Money supply. Money supply refers to the stock of money and money-like assets available in the economy for spending or for holding purchasing power. It includes not just cash, but also bank deposits and other liquid assets that can be converted into spending power fairly easily. For investors, this matters because money growth can influence demand, inflation, interest rates, and asset prices. If money is expanding rapidly, households and businesses may have more capacity to spend, borrow, and bid up goods or financial assets. If money growth weakens, economic activity can soften as liquidity becomes less supportive. The exact relationship is never perfectly mechanical, but broad shifts in money conditions often tell you something important about the policy environment. In that sense, money supply is broader than currency in circulation and more useful than many people first assume. Economists divide money into narrow and broad measures based on liquidity, which means how quickly an asset can be used for payments. M1 is narrow money and usually includes cash and checking deposits, the forms of money most immediately available for transactions. M2 includes M1 plus savings type deposits and other highly liquid balances that are not used quite as directly for everyday payments. Some countries also track broader measures such as M3, which can include additional liquid claims, though definitions vary by country. The broader the measure, the more it captures money-like assets that can support spending or portfolio shifts. This matters because a change in broad money can say more about overall liquidity than a change in currency alone. For investors, always check which money measure is being discussed before drawing conclusions. Central banks do not directly control every dollar, euro, or yen in existence. Instead, they influence money creation indirectly by changing reserves and the funding environment in which banks operate. When a central bank buys government securities, it adds reserves to the banking system, which can make lending conditions more supportive. When it sells securities, reserves are withdrawn, which can make conditions tighter. Reserve rules can affect how much room banks have to expand lending, and the discount rate can influence the cost at which banks obtain funding from the central bank. None of these tools mechanically guarantees a change in broad money, but they shape the incentives and capacity behind it. For investors, the key insight is that central banks influence money through the banking system rather than by directly dictating every loan and deposit. A large share of money is created by commercial banks when they make loans. When a bank extends credit to a borrower, it typically creates a matching deposit in that borrower's account, which increases broader money in the economy. So, bank lending is not just the transfer of existing money from one person to another. It often creates new deposit money in the process. More supportive reserve and funding conditions can make that process easier. But banks still need willing borrowers and acceptable risk. That is why central banks influence money creation, while commercial banks do much of the actual transmitting. It is also why a credit boom can coincide with rapid money growth. For investors, understanding this loan-deposit link helps explain why banking conditions matter so much for liquidity and growth. The textbook money multiplier is a useful teaching device, but it should not be treated as a fixed law of nature. In its simplest form, the multiplier is 1 divided by the reserve ratio. So a 10% reserve ratio implies a theoretical maximum expansion of 10 times the new reserves, but that is only a potential upper bound. In practice, banks may choose to hold excess reserves, borrowers may not want more loans, and some of the funds may leak out into cash holdings rather than stay in deposits. All of those factors reduce the actual expansion relative to the textbook case, so the multiplier is better understood as a guide to possible transmission than as a reliable forecast. For investors, that means reserve growth alone does not tell you exactly how much money or credit will expand. Changes in money conditions do not affect the real economy instantly. The central bank first alters reserves, or broader funding conditions. Then banks adjust lending behavior and the pace of deposit creation. Households and businesses react to those changing credit conditions by borrowing more or less, and only after that do we see clearer effects on spending, output, and inflation. The process can be strengthened or weakened by the broader environment. In a confident expansion, easier money may flow quickly into more lending and spending. In a stressed or cautious environment, the same policy move may pass through only weakly. For investors, the lesson is that money supply matters, but always through a transmission process shaped by banks, borrowers, and economic conditions. Investors watch money growth because it can signal whether liquidity conditions are becoming more supportive or more restrictive. Fast money growth can lift demand, but if the economy's ability to produce goods and services does not keep pace, inflation can follow. Weak money growth can point to softer credit creation and slower GDP over time. Relative money growth can also matter across countries because it can affect interest rates, capital flows, and exchange rates. The crucial comparison is not money growth in isolation, but money growth relative to real output capacity. If money expands much faster than productive capacity, overheating becomes more likely. For investors, money data are most useful when interpreted as part of a broader story about liquidity, inflation risk, and relative macro conditions. Consider a simple reserve injection example. Suppose the central bank buys $1 billion of government bonds from a bank, which increases that bank's reserves by $1 billion. If the reserve requirement is 10%, the textbook framework says the bank could potentially lend out $900 million while holding $100 million as required reserves. Under the simple multiplier, 1 divided by 0.10 gives a maximum of 10, so broad money could rise by up to $10 billion. But that is an upper bound, not a forecast. It assumes no excess reserves, no cash leakage, and strong willingness to lend and borrow. For investors, the example is useful because it shows the logic of money creation while also reminding you why real-world outcomes are usually smaller and messier. The same logic can be used in reverse for a textbook contraction example. If the central bank sells $2 billion of bonds to banks, reserves in the system fall by $2 billion immediately. With a 10% reserve ratio, the simple multiplier is still 10, implying a maximum potential decline in M1 of $20 billion. So if M1 started at $500 billion, the theoretical result would be a fall to $480 billion. But again, this is a worked estimate, not a prediction. In practice, banks may adjust in many ways, borrowers may behave differently, and pass-through may be incomplete. For investors, the point is to understand the direction and potential scale of a tightening move, while staying cautious about treating textbook arithmetic as reality. Money data are easy to misuse if you ignore definitions and context. One common mistake is treating M1 as if it were the whole money supply, even though broader measures often matter more for liquidity and spending potential. Another is assuming the multiplier is fixed, when real-world bank behavior, regulation, and borrower demand can all change the outcome. It is also wrong to think that reserves automatically turn into lending. Banks need creditworthy borrowers and sufficient confidence to expand credit. Cross-country comparisons can be misleading too because the definitions of M1, M2, or broader aggregates are not always identical. Even high money growth does not guarantee immediate inflation if velocity is weak or output can expand alongside it. For investors, money figures are valuable only when interpreted with care, definitions, and economic context. Section 5. Transmission to markets. Monetary policy usually appears in financial markets before it appears in the real economy. As soon as a central bank changes rates or signals a new path, bonds, currencies, equities, and short-term funding markets can reprice within seconds or minutes. Borrowing costs for households and businesses adjust more gradually, and spending or investment decisions take longer still. Only later do those decisions begin to influence growth, employment, and inflation. That full chain is what we mean by the transmission mechanism. For investors, this timing difference is crucial because market prices often move long before the macro data confirm what policy is doing. The first reaction is financial. The later reaction is economic. Policy reaches the economy through several channels at once, and different channels matter more in different settings. The interest rate channel changes borrowing costs for households, firms, and governments. The exchange rate channel affects exports, imports, and imported inflation as currencies strengthen or weaken. The asset price channel works through valuations, wealth effects, and collateral values, which can influence confidence and financing. The credit channel reflects whether banks and lenders are willing to extend funding, not just the rate attached to it. And the expectations channel may move markets before any concrete action occurs, because investors price what they think policy will be in the future. For investors, the real skill is identifying which of these channels is currently dominant. The interest rate channel usually starts with overnight or very short-term funding markets. When the policy rate changes, those short rates tend to respond first, because they are closest to the central bank's operational target. Over time, the effects spread into business loans, mortgages, and deposit rates, though not all at the same speed. There is also an exchange rate dimension, especially in open economies. If one country's rates rise relative to others, investors may shift capital toward that higher yielding market, strengthening the currency. A stronger currency can make imports cheaper and exports less competitive, while a weaker currency tends to do the reverse. For investors, this means rate policy is never only about domestic borrowing costs. It can also reshape currency moves in trade-sensitive sectors. Monetary policy affects much more than the cost of money. Lower rates usually raise the price of existing bonds because older bonds with higher coupons become more attractive relative to new, lower-yielding ones. Equities and real estate can revalue as discount rates change, even before earnings or rents visibly improve. Credit availability also matters, because banks can tighten standards and reduce lending even if policy rates are low, or loosen standards when conditions are supportive. Expectations add another layer. Guidance from the central bank can move markets even without an immediate rate change. In many cases, markets are reacting less to what policymakers did today than to what they now believe will happen tomorrow. For investors, valuations, lending behavior, and expectations are central parts of transmission, not side issues. Transmission is delayed and uneven because different parts of the system respond on different clocks. Financial markets can reprice almost instantly because securities trade continuously and expectations are updated immediately. Lending and spending are slower because they depend on contracts, bank decisions, household confidence, and business planning cycles. Some channels may weaken sharply during stress, especially if banks are under pressure or borrowers are already heavily indebted. In that case, even large policy moves may not produce the usual response. Inflation is often the slowest variable to move, which is why full effects commonly take 6 to 18 months. For investors, uneven transmission means you should never assume the same policy move will have the same effect in every cycle. A useful way to track policy is to follow a typical sequence. First comes the policy announcement, which sets the process in motion and often changes market expectations immediately. Money markets and short-dated yields adjust first because they are closest to the policy rate and expected policy path. Bonds, currencies, equities, and credit spreads then reprice as investors reassess growth, inflation, and discount rates. Over the following days or weeks, banks begin updating lending terms and deposit pricing. Only later do those changes affect borrowing, spending, investment, growth, and inflation. For investors, following the sequence helps separate first-round market reactions from later-round economic consequences. A quarter-point Fed hike can illustrate this timing very clearly. Within minutes, the 2-year Treasury yield might jump from 3.80% to 4.00%. The US dollar might strengthen against the euro, and the S&P 500 might fall, especially in growth stocks that are more sensitive to discount rates. Within a couple of weeks, banks may raise their prime rate and mortgage rates may move higher, making borrowing more expensive for households and firms. Over the next several months, issuance in credit markets may slow, housing starts may soften, and retail growth may ease. The key point is that the same policy move creates a sequence of effects rather than one single outcome. Fast reactions appear in yields, currencies, and equities. Slower reactions appear in credit and real activity. For investors, Mapping that timeline is one of the best ways to interpret what a central bank move really means. What investors should watch is not just the policy move, but the path it takes through the system. Do not assume an immediate and complete pass-through from the policy rate to borrower rates, because bank behavior and credit demand can slow or block it. Pay attention to guidance as well as the formal decision, since expectations often drive markets before lending and spending respond. In global investing, currency effects can be just as important as domestic rate effects, especially when relative policy paths diverge across countries. It is also important to remember that lower rates do not guarantee more lending if banks are cautious or borrowers are weak, and the dominant transmission channel can shift over time, from rates to credit to exchange rates to expectations. For investors, the right question is always, through which channel is this policy move actually working, and what might be stopping it?